desire to keep Greeks in a comfortable lifestyle either. It's to protect their own banks and other institutions. I mean, there's a real self-interest. It's not just to keep the euro or the eurozone together. It's to protect your own country's banks and other financial institutions. You can see where the Greek debt is held by country in the banks and the insurers, in other financial institutions, mutual funds, pension plans, and others. So people have a real vested interest in keeping Greece from failing, and keeping in turn then those institutions potentially from failing. If they don't rescue Greece, they may have to rescue their own banks. So it's a choice of, do I spend money here or do I spend money here? I heard something this morning, it was very interesting, and I think it was Spain and Portugal they were talking about. Spain and Portugal are going to be loaning money to Greece in this rescue bailout effort at a lower rate of interest than they have to pay to borrow money out in the public market. They've got to do it. They feel they've got to do it. They can't let anything fail. It's what we went through. We can't let anything fail. But a failure of any of these institutions would certainly exert deflationary pressure on the European economy and in turn on the world economy. In the U.S. and around the world, there's been a tremendous increase in money and credit inflation over the past 2 years. In the emerging market countries, we're starting to see that translate into price inflation. In fact, India is up in the mid-teens, 15-16% inflation. I saw something about Brazil being in the 8% or so area. So far that inflation has not spread to the U.S. and most developed countries. Some countries are starting to tighten their monetary policies, which would tend to counteract inflationary tendencies. U.S. conditions, especially unemployment and housing, leave the Fed with the desire to keep these rates as low as they can for as long as they can. But the problem there is that tends to produce financial distortions, and it lets bubbles develop, which we know well from the very loose Fed actions of the past decade. By the way, it just struck me the other day. I was just doodling away with some thoughts and writing some notes out. If this approach to really revving business up by stimulating the economy, by subsidizing this and subsidizing this, if that were a really good idea, why wouldn't we do it all the time? Why not? I mean, if it's a good idea, why shouldn't we always do it? You know, and I was mentioned that to somebody the other day, and he rolled his eyes, and he just says, well, because obviously there are deleterious side effects. But we're not dealing with those right now. We're obviously seeing the massive buildup of debt, which is either going to be paid off, or written off, or papered over with new money, one or the other. And one or the other or the other. But it's clear, we hear the good about stimulus, but when you think about it, we don't do it normally because of the side effects that we're afraid of. So when do those come back to bite us? Or have the people who are running these stimulus and rescue programs, who, by the way, were essentially the same people who didn't see the crisis coming in advance, and now we've invested great confidence that they can solve the problem. We are a people of great hope. Political will is also waning, I suspect, for more bailouts. I think this is going to get tougher and tougher to try to bail a bank out tomorrow, or Fannie Mae or Freddie Mac. We've already committed to them. By the way, that's an open-ended commitment for the next, I forget how long, year or two, 3 years, something like that. So any money they lose, we got to give it back to them. But then in the Greek situation, we're seeing countries kind of hold their noses and bail rather than allowing bank failures. So what's the prospect? There's a very good book. It's not easy reading. It's not fun reading. Carmen Reinhart and Ken Rogoff wrote This Time is Different. It's a very long, academic, table-filled tome tracing monetary crises over a period of about 800 years. It's a very, very good academic work. And they make the point from the long view of history that there is obviously a long-term trend of inflation. Over the long term, let's say 20 years or so, that's probably a pretty good bet. I mean, if you had to say where are we going to be 20 years from now, probably bet inflation. That's the lesson of history, with a considerable amount of consistency. We also know, however, from history, that severe banking crises, and ours certainly qualifies as severe. The system was essentially broken, admittedly, by the people who run it and by outside observers like Warren Buffett and others. But severe banking crises are typically followed by severe and protracted economic contractions. Now, our economic contraction was certainly severe, no question about that. But because of the tremendous amount of rescue money that was thrown in, it was not protracted. So we have thrown all this money in, which money, by the way, of course, didn't exist. This is a pledge that your grandchildren's grandchildren have made to bail us out for the folly that we have permitted to occur on our watch. But we haven't solved the problems. That bad paper that nobody could sell a year and a half ago, which essentially made the credit markets freeze up, most of that hasn't matured yet. That's still sitting on somebody's books. Now, the Federal Reserve has been nice enough to buy a lot of the mortgage-backed paper that had no market. And I had dinner with our friend Martha Seeger, who was a Federal Reserve governor some years ago, just a few weeks ago. And Martha was just horrified. She said, I cannot believe that the Fed would put that garbage on their balance sheet. I mean, this was something, I just said, was that kind of thing ever even discussed when you were on the Fed? She said, it would have been laughed off. It was just inconceivable. All they were ever to have on a balance sheet was the highest quality government debt. But now they own mortgage paper which had no market. It was so weak. The world has changed. But that paper's still out there. So it's saying we haven't solved the problems. The problems are still out there. We're trying to buy time to get past so those problems can be solved. As events like the uncertainty in Greece, which is small by comparison with the many other bigger countries with debt and deficit problems, and the ability of the U.S. stock market yesterday, for example, to be able to lose almost 10% in less than an hour, really shows the amount of nervousness and fragility that is out there in the system. If people are willing to write down assets by 10% in an hour, there's a lot of lack of confidence out there. It all hangs together with confidence, or it fails with a loss of confidence. And our ability to pursue our rescue problems rests heavily on the kindness of strangers and their willingness to let us continue to spend more than we earn. And you see that on the page 28. These are the two biggest relatively new